Welcome to Chart of the Day. Jeffery Kennedy and Todd Gordon carry out a real-time trade. This is a different Chart of the Day. It shows an edited version of a longer video of the weekly conversations between EWI's Jeff Kennedy and CNBC commentator and trader Todd Gordon. You'll see them discuss, open, and then close a recent successful trade.
This is going to be a trade update. This is going to be a live trade, live position update, and a closure of a trade in JP Morgan. Now, Jeff Kennedy and I are doing a joint project. Maybe you've seen it. We meet once a week and we'll exchange ideas, analyze charts, and then execute potential trade setups with live capital. One of those trades was JP Morgan. Now, as much as I would like to say that this trade was very easy and worked out according to plan, didn't go that way. This one tested us quite a bit. We actually put this trade on back here March 19th, as we'll take you through the chronology of this trade and go do a forensic analysis. It's important to position size correctly, I think, is the takeaway of this video. Position size such that you have an idea of where risk management would be, but ultimately the Elliott Wave count, the Elliott Wave methodology is a living, breathing, dynamic style of analysis that requires you to adapt to an ever-changing market. You can't go into the markets or life, so to speak, with just a singular expected outcome and say this is the only way life or a trade is going to unfold. As you know, life or the markets can take multiple paths, and you have to be able to adapt. And the way you can adapt and survive through the drawdowns is to be position size correctly, mitigate risk at the beginning, position size according to what is appropriate for your potential or for your specific count, and then you're free to operate and trade the trade to completion. First, let's do JP. So I could see right away you're looking at red wave 3 to get up to the 1.618, which matches up with the old highs.
Well, the key thing with JP Morgan is everything since October, that's a counter trend move. It's not an impulsive decline. As a counter trend move, we can expect it to be more than fully retraced. I like this up, down sequence. Again, double failure, swing low. From an Elliott Wave perspective, 1-2-1-2, a lot of reasons to be bullish. Small little bullish island reversal that occurred earlier this month in the month of March. And even if we go down to the short-term substructure, here's that very small bullish island reversal that you see in JP Morgan's price chart. And then from there, it's just higher highs and higher lows. And as it's written in much of the technical analyst literature, that's what defines an uptrend. Nice little small pullback right there. You can kind of see what I'm anticipating as we move into the next 5 to 10 trading days. Technically speaking, we have no business in purple wave 4 or Roman numeral wave 4 in parentheses below the extreme of wave 1, which is right there. That comes into play at 105.87.
So if we look at the options market going out into 5 Aprils, I wouldn't mind going up to about the 108s, go a little bit out of the money. Selling the 112s, buying 108s for $1.50, selling 112s for 33 cents. So buying the 108, selling the 112. It's a $4 spread, paying $113 to make $300 or $287 potential profit. So that trade will work for me. Do that 5. I'm going to put a little bit more size on there. I'll do a 10 lot, risking 1,120. I'll generally manage it at about half. So if the trade gets down to about $500 or $600 loss, I will begin to manage it. Otherwise, we have a potential reward of $2,800 on max potential loss of $1,100. That trade is now working. We do have a losing trade on in JP. JP, I'm down about $700. So the idea is to have bigger winners and smaller losers, right? We have the 108, 112 call. We still have 10 days to go. It's 105.23. If we are looking at a third wave, that third wave should happen soon. I don't want to change the position. We still have time for this to work. So the question I'll put to Jeff is 10 days out. Do you want to let this go? or do you want to, again, roll it out, put it out to perhaps May, spend more money on the trade? What do you think?
Once I initiate a trade plan, personally, I don't like changing that trade plan. Well, I'm comfortable letting the initial position that you took just ride in JP Morgan.
Looking at Jeff's charts, 109 over the next 10 days could be possible. That's a break-even scenario at expiration in 10 days from now. So I'm going to let that one go. I will alert people if the position has to be adjusted. Long story short, we got to the position where like, okay, it's probably still in a higher degree third wave. So we decided to stay with this trade through earnings. Earnings were released last night, and by the skin of our teeth, as these options expire today, we are in a great position. We bought this trade we paid $1.41 for the 108 calls. We sold 112 for 29 cents. That net difference, 141 subtracted from 29, so it'd be $1.10 or 11 or whatever that is the total cost for a $10 spread. So currently we're up about $2,000 on the trade, which winds up being a nice profit for us. So I'm going to go ahead and just simply book the profits. And the way I'm going to do this is I'm just going to sell the spread, which is now trading for $3.15. We essentially paid $1 and change for it. Now we're selling it for $3 and change. So certainly a nice reward on the initial payment. So let's go ahead and see if we can get filled around 314 and filled at 315. Thanks very much.
Hope you enjoyed that. For more, visit tradinganalysis.com. Thank you.